Jenny Brown, and a very warm welcome to MFB Live. Thank you so much for joining us today. I hope you're all keeping really well. We've got a really good agenda lined up for you today with some fantastic industry leaders who are going to be joining us to give us some advice and give us some thoughts on the buy-to-let market. So, by way of what you can expect, an agenda for you. First of all, I'm going to be handing over to Steve Elenick, Managing Director of Mortgages for Business, and he's going to be hosting our lender panel. And he's going to be joined by Richard Rowntree of Paragon Bank and Hans Geberbauer of Foundation Home Loans. After that, I'm going to be chatting with Julian Sampson of TWM Solicitors and Chris Frame of GetGround, where we're going to be talking about limited companies, structures of them, and why people would use limited companies in the first place. After that, I'm going to be chatting with Sales Director of Mortgages for Business, Gavin Richardson, talking a bit more about how you can get mortgages through limited companies and what the market is like there. And then last but by no means least, I'm going to be answering some of the questions that you have emailed in the run-up to this event. So lots of really exciting content for you today, which I hope you're going to find really useful. So let's get started. First of all, I'd like to hand over to Steve Elenick, who's going to be hosting our lender panel. Steve, over to you.
So, hello and welcome to the second of our lender Q&A sessions, where we chat to a couple of specialist lenders to get their current view of the market. Today, I'm pleased to say that I'm joined by two prominent business leaders, especially in the buy-to-let mortgage market. So a couple of introductions. My first guest is Mr. Hans Geberbauer, CEO of Foundation Home Loans. They're a specialist buy-to-let and residential mortgage lender. Hans has worked for Foundation for about 18 years, I think, Hans. And prior to that, he was associate at the London offices of the law firm Allen and Overy, where he qualified as a solicitor in 1999. Completed his legal studies at the College of Law in London in 1997, received a BA in history from the University of York, I think, in 1995. So welcome, Hans. Thanks for sparing your time.
Thank you.
My second guest is Richard Rowntree, Managing Director of Mortgages at Paragon Bank. Welcome, Richard.
Thank you.
Richard joined Paragon just January this year, I believe, Richard.
It was, yeah.
You're responsible for Paragon's activities across buy-to-let, second charge, and residential mortgage lending. Before joining Paragon, Richard was Managing Director of UK Mortgages at Bank of Ireland. Richard also held senior roles with Royal Bank of Scotland on the Williams and Glyn arm, Santander, Lloyds TSB, Halifax. You're also a non-executive board director of District Housing Association. So, welcome, Richard. Thanks for giving up your time today.
You're welcome, Steve. Thanks for the invite.
So I thought I'd start just by setting the scene and giving our viewers a bit of context, really, about where you both sit in the market with regard to size of operation, headcount, to the market share and that. So, Richard, perhaps you could start with telling us a little bit about Paragon.
Sure. So Paragon is a specialist and complex buy-to-let lender in the main, but it's broader than that. It's a full-service bank which has 1,300 or just over 1,300 employees. It has a diverse funding, so we have 7.6 billion in terms of deposit funds, but also access to the term funding schemes and securitization, so it's diverse and well funded. We have 62,000 buy-to-let accounts, so it's very sizable. We've been lending buy-to-let since 1996, and we've lent 23 billion over that time, and currently have an active balance sheet of 10.8 billion. And as I say, the focus of that is around the specialist and complex elements of buy-to-let.
I remember you were there right at the early days of buy-to-let when you Paragon, one of the early supporters as buy-to-let came in. Foundation, slightly different size, Hans, I guess, and different funding.
Well, absolutely. Paragon is what we aspire to be when we grow up. Yeah. In the meantime, so we have on the balance sheet 2.4 billion of first-ranking mortgages. Some of them are still from legacy from the pre-crisis, by which, of course, I mean the pre-great financial crisis rather than the current crisis. We have 3.5 billion under management. Not all of that is on our own balance sheet. We have over 2 billion of that is newly originated under the Foundation Home Loans brand since 2015, with the emphasis on that in recent years. Foundation Home Loans is primarily, from a volume perspective, a buy-to-let lender. But recently, especially in recent months, our owner-occupied proposition is becoming stronger and stronger, partially because we're seeing that there's a lot less supply in specialist owner-occupied. We have 250 people. We are Bracknell-based, or would be if we were allowed to actually be here. So I'm one of the very few in the office today. In the Thames Valley, we are really fast-ranking mortgage lender only. We don't do any other lines of business, and we exclusively wholesale funded. So we basically use bank financing for warehouses, and then exit into the securitization market. We have an exceptionally long and well-regarded track record in the securitization market, going back to way before the great financial crisis, and encompassing both new originations under Foundation Home Loans, as well as legacy assets, whether we originated them back in the day or whether we acquired them in the secondary market.
Thank you for that, Hans. I think that moves sort of quite nicely onto the next subject about the last 6 months and the challenges we've had during lockdown, and I guess the differences in the way you're funded that has added to those challenges. I guess, I mean, Hans, probably best for you to kick up on that, on how, the difference, the way you're funded, relying on that wholesale funding market. That's been quite a challenge over the last few months, hasn't it?
Well, the primary challenge has been when the surveyors were unable to do any surveys. The securitization market, as it stands today, really won't bear any loans which are done without a physical inspection, especially at the kind of end of the market where we want to be competitive. I'm not saying it couldn't be done, but by the time we go down to the kind of LTVs, I think those investors would contemplate without a physical inspection. Not quite sure we're competitive with those LTVs. I think the banks would do that much better. So we were really unable to do that, and although we investigated the options along with quite a number of our competitors, ultimately surveyors luckily came back quickly enough such that became a slightly moot point. But we also found that is going to be a much longer education process. So that was just a supply chain issue, if you like. There was dislocation in the pricing, there's no question about it. So if you'd had to put out the securitization in May, you might have failed, but you certainly would have paid extremely dearly for it. But what we've now seen, and we've had a number of macro knocks, starting with the Brexit referendum back in 2016, I think it was. There is a bedrock of securitization demand, which requires supply. And this comes from the type of investment mandates that certain houses have and investment needs that they have for the mix of duration, pricing, and risk. That is securitization bond of backed by buy-to-let or owner-occupied mortgages actually covers very, very, very nicely. And most of those accounts are actually native accounts. So they don't really go away, whether it's Brexit or not, there's always going to be better. What they may do, though, is sit out a quarter or two if they're very uncertain. So the real key is to have a lot of warehouse funding at all times and pay for it, quite frankly. You don't get that for free, right? You don't have that on tap without paying a charge for the water supply being there the minute you turn the tap on. But that's what you need to do. And if that's what you have, you can continue to originate into your warehouses, because we're not really seeing securitization markets being dramatically disrupted for more than 3 quarters, quite frankly. It's because there is that core demand. They do actually need some supply, and our supply is high quality. So therefore, generally speaking, it finds a home. So, but yes, it's been a pretty fascinating ride. But we're almost getting used to it, aren't we, Steve?
Yeah, it's been a lot easier for you banks, Richard.
I don't think it's been easy for anyone, Steve, and certainly wasn't the introduction I was expecting during Paragon at the beginning of the year. So, but at least I was fortunate enough to have the first quarter before the pandemic kicked in. And I would say Paragon's a fantastic organisation to join. It's very warm, it's very welcoming. So from that point of view, it's very good to have a very solid introduction before we got into the challenges of what we've seen over the pandemic. And ours was slightly different. We didn't have that funding challenge, as Hans has just identified. Operationally, we were pretty resilient as well here in terms of what we've done in terms of accelerating the working from home, which is pretty much normal now for everybody. Yeah. Within a week, we had 90% of our staff being able to work remotely from home, Teams and Zoom and everything else. And also actually being able to take broker and customer calls. So very, very quickly, that was clearly a challenge, handling the payment holiday or payment deferrals, as that's now named. That work, as well as operationalising the movement of the teams to work from home, worked very, very well. And we maintained that service standards, which are very much under pressure from everybody at the moment with the demand, but answering 90% of all calls within a minute. So I'm very, very pleased with how the team has responded operationally. But I think the challenge is also clearly there's concerns around house prices, what may happen in the macro environment, but we chose to make our changes very, very early. So from a criteria perspective, and wanted to be very, very consistent. I was trying to very much avoid chopping and changing and making continual pricing changes. So we set our stall out early, and that's allowed us to remain pretty consistent actually throughout the entire pandemic, not having to continually change prices or criteria. So I've been very, very pleased with the team's response actually.
And you were able to rely on some sort of desktop valuation methodology, automatic valuations, while valuers weren't able to go out where?
I think that there's still the challenges Hans mentioned around physical valuations, and we're fortunate enough to have a real advantage of our own in-house valuers. But clearly, when we were physically restricted during lockdown, this became a challenge. So we worked up a process that allowed us to do in simple self-contained transactions, a desktop process, which was more than just a sort of AVM. It was very much a localized, using lots of data sources to give us confidence around comparables and lots of good evidence. So we were able to do that. But at the same time, we remained in HMO and multi-unit blocks, underwrote those cases, but just wouldn't actually get to offer until we could physically get inside the property again.
And on sort of other operational challenges, Hans, I mean, was there resource issues as you had to deal with mortgage payment holiday calls or mortgage payment deferments coming in?
We got through those really, really well, partly by luck and partly by design. So by design, certainly because we have always believed in having our own in-house servicing. So we've always serviced the post-completion book ourselves, something we quite passionately believe in. So we've always had a pipeline of people going from the back book to the front book, and originations, new business processing, sales, as that side of the business has really grown in the last 5 years. Now, while that side of the business became partially idle, while the surveyors were unable to do their jobs, well, we were able to post a lot of those people back literally on 24 hours notice. And a lot of them actually came from that area, so they already had the requisite training for customer conversations in the post-completion world. And all of that really helped us to resource it up. So at some point, we had over 20 people posted back into the post-completion world to help with primarily with mortgage payment deferrals and those conversations. So that just shows how flexible we were. And as a result of that, we were able to have a conversation with every single borrower who required an MPD. So we never open up a channel where people could just take a box or fill in a form on the internet. We had a conversation with every single borrower, and we are having conversations with every single borrower as they come to the end of the MPD. And again, that's something we're very passionate about. In terms of working from home, and I think this is partially by luck and partially by design. By design, to the extent that we have an IT department which is just very thorough. They've always been very good about being very on top of infrastructure, kind of like pretty boring stuff, quite frankly. Yeah. Not something you brag about in a fintech context, just making sure that there's resilience. And when it came to making the switch, it just worked. And if you'd asked me a day beforehand whether this was going to work, I would have said no way. And it worked beautifully. But that also had a lot to do with the fact that our staff just really rose to it. It's just extraordinary what they did. And if you think about it, especially in the post-completion end, they had a lot of phone calls to make. These are not people sitting quietly at their desks. These are people handling phone calls from members of the public, from our borrowers, who at that moment often were in distress, because that's why they're called, right? Because why else would you call your mortgage lender? And they handled all of that from their kitchen tables, from their sofas, with laptops. Sometimes they're often their own laptops, actually, with just a little bit of additional equipment from us. So that's something we had to do over time. So it worked immediately and so well that we're actually struggling to get anybody to be interested in coming back, like ever. But I can't say that was all planned and all been tested like that. It just came about that way.
Yeah.
And we were just blown away by how good our staff were at stepping up to it.
Yeah, I mean, we could mirror that at Mortgages for Business. The next day we were all had the setup, had the technology to work from home, and the attitude from the staff's been great. I think all business surprise themselves how agile they've been. And you're right, Hans. It's why would we go back on some of those old practices? So,
yeah. Well, I don't miss the commute unless it's on a day like this. Cycle in.
I don't miss it in 25 minutes. That's good. I mean, we touched on mortgage payment deferments there and government loans, and it's been a hot topic now for some time. I know both as lenders you've had to deal with those influx of calls, but going forward, how are you looking at new applicants with regard to their history about NPDs and government assistance? Maybe Richard, pick that one up first.
Yeah, sure. So we've seen this mature, and the understanding of what this may look like, I think, has changed over the summer. So I've been close to this with my work as part of the Mortgage Service and Product Board at UK Finance in helping shape some of this policy and influence and lobby on behalf of what's right for customers. And I think it's slightly different for buy-to-let, because clearly what we're looking to do is provide forbearance for tenants. So we're reliant on the landlord applying that. And we did see landlords reacting very, very cautiously at the outset of the payment deferrals, and quite large numbers arising, and those numbers have been published across UK Finance now. What we have seen throughout the summer is that caution, not seeing things quite as bad or the right side of bad in terms of what's happening and in terms of the macro environment. 95% of tenants are still paying rent, according to the National Landlords Association, and landlords are supporting tenants in terms of those that are struggling. So we're not seeing the sort of numbers we had before. But I think what we should really emphasise here is that each case needs to look at on its merits in terms of the type of landlord, the students, for example, what exposure they have to those type of markets. But so we would like to understand whether that's payment deferrals or bounce back loans. What is the health of the underlying business? So certainly every case looked at on its merits, and we've got more experience and understanding of how that's played through. Because remember, you can't have that reliance on the credit reference agencies as well, because clearly that's been not kept up to date over this period of time while we're allowing this forbearance. But from where we were and not knowing what the answers were to where we are today, I think we've moved on a huge amount. And pleased to say we're helping many that have taken advantage of the schemes with new lends.
Are you seeing many landlords trying to use bounce back loans as deposits as part of property transactions? Are you seeing much of that?
We haven't seen a huge amount. Clearly the bounce back loans is designed to support SMEs. And so, a valid reason may be adding to your portfolio. That's not really been something we've seen. What we have seen certainly is a move to more professionalisation in the market as stamp duty holiday has encouraged more and more landlords to incorporate, but not necessarily looking to use bounce back funding. But I suspect that there has been an element of building up reserves to look for opportunities, whether that's been payment deferrals or by any means in just shoring up cash to take advantage of any opportunities that may come.
Yeah, and then there's always questions around whether that's in the spirit of the scheme, isn't it? I mean, what's your thoughts, Hans, and what's your stance been on people taking assistance?
Well, we also take a differentiated view. So a classic example is if we see a portfolio landlord who has taken blanket MPDs across his entire portfolio in a single swoop, that's not something we look upon very favorably, because it doesn't strike us as somebody who's actually put any thought into it, and either did it very opportunistically or wasn't really on top of his portfolio, and therefore it felt the need to do defensively in a flash because he or she didn't really know what was going on in their portfolio. So either way, that doesn't to us is not a signal that somebody's on top of what they're doing or doing it right. We have no problem with where we look at the cases where landlords are doing it to support tenants who have temporary cash flow issues and therefore unable to temporarily pay their rent. Well, that's exactly what it's designed for. And there's no way we would be penalizing anybody for that. And we obviously look at, okay, fine, how's that going to come back? What's the medium, is there, is it a temporary disruption? Will you be able to get back on with your existing lender in terms of paying again? But that's exactly what that's there for. Now, we have, of course, overall seen a relatively low take-up of MPD, and in most cases also very considered take-up of MPDs, rather than a blanket one. We've all come across some pretty egregious cases.
Yeah.
They do stick a little bit in the craw, but the reality is that they are not remotely reflective of general practice. The current environment we're observing is so obviously we're now in the extension period, the second period, so to speak, and take-up is extremely low, both on buy-to-let and, in fact, in our own occupied book as well. So we're seeing very little new. We are seeing more extensions of the existing ones, the initial 3 months one, but almost no new ones at all. And we're having positive conversations, generally speaking, about getting back out. But the vast majority of buy-to-let landlords are actually just paying, even when some of their cash flows have been disrupted at times.
Yeah, I think you're right. We're seeing, as the markets become more professional, they are running it as professional businesses and are taking a view on those. In the past where there was a lot more sort of amateurs, it may have been a different story, but.
Yeah, and I think we're seeing that also, Steve, in terms of coming to the end of those payment holidays. What are we doing? So are they extending? We're seeing 80 to 90% of landlords capitalising and just moving on from that point of view. So that's very positive and very, very small numbers. I know we haven't seen the end of the furlough scheme and what impact that may have at this point, but certainly, as I say at the moment, very, very positive signs in terms of coming towards the end of this.
Excellent, that's good to hear. Another hot topic's been what's happening in the student markets. I know you're both lenders that have lent to landlords who let to students, both HMO lenders as well. Are you hearing anything from landlords with regard to problems with student lets, or what's your current stance with regard to the student market?
Shall I take that, Steve, to start? So yeah, we're very experienced in terms of the student market. We have exposure across 22 different cities, and it varies. So I think it's very much dependent on local demand. And we're not a huge lender for very, very specialist, purpose-built student accommodation. We do have some of that, but it generally tends to be in first university towns, really, in terms of where there's strong secondary demand as well. So even if there isn't student demand, potentially key workers, professionals, etc., could take up that secondary demand. So I would say we're out of that market at the moment. That was one of the decisions we made very early on. And as it currently stands, the decision to remain out of that market is more to protect service, actually, because we've been able to maintain service over the summer. But it is something we're looking at because it's bounced back more positively than what I would expect, actually, a number of areas. We're getting very good feedback from our in-house valuers that give us on-the-ground, localised, town-by-town, city-by-city, in-depth knowledge and understanding. So it's a considered view that we're working through at the moment to understand what they may look like. But I think it's helpful now we're through the challenge we've had with the A-levels. That's been resolved. And there's lots of talk about foreign students not being able to come here. But I think equally it's worthwhile remembering that domestic students won't be either studying abroad or the gap years. There's not much opportunity for the gap years at the moment. And I'm not sure that the UK has quite the pool of some of the travelling that students are used to in that time. So I think you are going to see a bit more student demand. And whether that's online or not, and we've locked up children with their parents for a long, long time.
They still want
I think they're looking for more than just they're looking for more than just the lectures, aren't they? Absolutely. So I think let's see how that plays out. The next few weeks, I think, is going to be very telling.
Yeah, watch this space. Hans, where are you on student lets at the moment as a lender?
So in principle, we will still look at them. In terms of the general situation, and Richard alluded to this, this is literally playing out in real time, right? And so we're now like at the so part of our research has been to go around our staff members with university starter age children and say, what are you kids doing? Are they going back on campus? Are they staying with you? What's happening? Because it's a very unclear situation, isn't it? And some of the guidance.
My daughter's going to Sheffield University on Saturday to start, so that's still on and all going. So
what you mean is she's actually physically going to Yorkshire.
She's going, yeah.
Excellent. There you go. So that's my research. I'm going to make a note here.
Okay, you're welcome.
So what we found is, and this is not scientific, what we found is exactly what you're saying, is that most people are actually trying to make a go of it on campus, and actually most universities are trying to have a semblance of campus experience. And that obviously means that most people, I think, will have committed to student loans, to their student accommodation. They will try to take it up, and they will try to live that life. But we still have to kind of like watch a little bit how this goes through. I mean, my son's at Imperial, which has a massive proportion of foreign students, and he said he's a postgrad. And he said it's very, very unclear what's actually happening. He can't really tell what's going on and what actual lectures are happening there. But I think that's not a typical university because it has such an enormous proportion of foreign students, not non-UK and not non-EU students. In fact, I think most of what we're talking about and where most of these properties are that we're talking about that Richard and ourselves lend on are actually more in the classic university towns, dotted around the country. And it looks like for this year, at least, it's going to be okay. But I would still put a question mark over next year, depending on how that experience shakes out, because if the on-campus experience still is too locked down. So Richard was subtly alluding to things other than lectures they may care about, right? But if they all have to be done under social distancing, again, the on-campus experience may not be quite what people are looking for, right? So have to see how that goes.
Yeah.
Certainly looking at where properties are, we're also looking a little bit at, okay, what would be the other demand for the type of property we're looking at in the locality.
Yeah, just watch this space, I think, for both of us, isn't it? Yeah.
Yep.
Good. So as we sit here, we're sort of 6 months in from lockdown and the market's picked up. It's, we're seeing inquiries coming in. It's quite buoyant, really, better than I thought it was going to be. But, that is being propped up by a stamp duty holiday. I'm not sure what the market's going to be like post March 21. Richard, have you got a view on the buy-to-let mortgage market once the holidays, if it's not extended, what's it going to look like?
I think it's impossible to be right on this one, Steve. We can all have a view, but I think all we can guarantee is that we'd be wrong. I think in terms of if the stamp duty comes to an end, we can probably look back to tax changes in 2016 to see the sort of behaviours you might see. Yeah. So we're certainly gearing up to ensure we're resourced early part of next year to help see through that pipeline. I suspect.
No staff holidays in March. Yeah?
No, I think we'll have a well-deserved break come April, but we're gearing up for that. But yeah, I think it depends more broadly. We're very, very pleased in terms of it's not just pent-up demand we've seen. There's definitely a significant boost to transactions we've seen at the moment. The stamp duty was very welcome for landlords. That's added momentum as well. So I think we're bullish about the short term. We'll have to just wait and see in terms of how that plays out in the long term. We're prepared either way.
Hans, you got crystal ball?
Yeah. Well, certainly right now, in terms of actuals, we're seeing phenomenal volumes of business. So we're writing more business than we ever have done before. I believe that it's actually still going to be the buy-to-let landlords that are going to supply key demand post-March. Because if you look at house prices now, they have taken such a boost from the stamp duty boost that actually the stamp duty savings in many places will in fact have been sort of wiped out. So if you're the buy-to-let landlord, especially the one who builds a portfolio and who's looking for, a bargain for want of a better word, I'm not quite sure now is the market in which I would do that, unless you wanted to go very contrarian and buy a high-rise flat in central London, which is probably one of the few markets that's really suffering at the moment. So we in fact are already aware of a number of portfolio landlords who are sitting on their hands because they think this is not a good market to buy in because it's too frothy. They're waiting for after March. And even though then the stamp duty will kick in fully, they think it will be more than made up by the house prices actually moderating and there being a lot less excitement and even an element of overexcitement. We think that will be critical in dampening any sort of like cliff edge type crash that we might otherwise suffer for the rest of the year. Specialist owner occupied, incidentally, continues to be noticeably below the levels that we observed pre-lockdown.
Really?
So there's a lot less activity there. So at the moment, we're currently growing our market share, which we're quite pleased with, but we're growing it. The market has become a lot smaller for the time being. Whereas buy-to-let, or specifically certainly our corner of buy-to-let that we monitor, is now back to where it was, in fact, slightly bigger than it was pre-COVID. So you agree with Richard, it's very, very strong levels of demand. It's not just a bounce back, although it's, a lot of it is enthusiasm as a result of the stamp duty. So that's really positive. And as I said, I think it's the really professional landlords that really look for bargains and take long-term views that will come in and help us smooth out business levels come the end of the stamp duty holiday.
I hope you're right. I think because we will, naturally there'll be the normal purchase business sort of April, May, June coming into March as a result. So I hope those professionals are going to be active, because I think what I am looking forward to is probably when we get to Q4 next year, that October time, which is the 5-year anniversary of the stress test changing, when the PRA rules change. Because a lot of landlords then went into 5-year money, wouldn't they? So I think the remortgage should then pick up again as people come out of 5-year deals. So it's just that hiatus between probably April and October is where we don't know.
Is that already 5 years ago? Time flies.
Doesn't it just?
It will be 4 years ago now. Yeah, exactly. Yeah.
So I'm conscious of time. So let's finish up. Just, you mentioned the word resilience earlier, Hans, and certainly we've seen that the professional landlord has been resilient through a mirage of tax changes and lender underwriting criteria changing for them. They're always looking at ways to sort of increase profitability, whether it's refurb. We've seen a lot go into holiday lets, semi-commercial now. Are there any innovations or product changes that you're looking at to stay supportive of the professional landlord? Maybe Hans, you can pick that up.
So we are back to our full range. So in fact, we have reintroduced our short-term let proposition as well.
Does that covers Airbnb and that as well, doesn't it, Hans?
Always underwritten to an AST. So basically, if it were in an area where you can only do holiday lets, that's not for us. That we don't do that. Some other lenders do. We don't. So there has to be an AST market and an AST value you can establish and underwrite to. But other than that, we permit that, and we are happy to support that. Again, what we saw in the crisis, very interesting, is that a lot of our landlords on that product, whom we did often support with MPDs, because obviously they literally lost all business because travel was basically banned. But of course, most of them then pivoted very quickly to short-term lets to key workers. So there was quite a bit of demand around that, and they just changed the way they did business, and they changed their clientele, and that worked out. And actually, it underlines how resilient and resourceful this kind of customer base is, which is why, on the whole, they're quite a pleasure to lend to, quite frankly. Yeah. But that's it. So we still offer back. We're back to our full range of product within which landlords can pick really what best suits them and pursue their strategies. There's no question that, generally speaking, and that's probably less to do than with our products, is in a volatile environment like this, cash flow, free cash flow, really, really matters. Being on top of your information really matters. As I said, some people, I think, were a little bit caught out about not really knowing quite what their tenants do all day and maybe how they make their money and things, or even how to contact them, or how to deal with if all your tenants contact you within a very short space of time. Building that little bit of operational resilience is quite important, especially for those with the larger portfolios or those who've only just built a bigger portfolio and are not quite used to it yet. As I said, that's not to do with our products, but that's, I'm sure, on the top of everybody's mind amongst the portfolio landlords and indeed their advisors like yourselves, right?
Yeah, no, spot on. What about you, Richard? Sort of any innovations coming from Paragon to keep up with the landlords?
Well, I do think we're going to continue to see the professionalisation of the market, and I think the private rental sector is going to be vital to support wider society, whatever the outcome in terms of the fallout from the pandemic. So I think the demand is going to be sustained. I think it's an interesting in terms of some of the things that we could revert back to. So that's in our thinking, but also just in terms of how we reimagine our high streets, and does that bring opportunity, for example? So we've seen a big impact on leisure and retail, and also the planning rules in terms of the build strategy from the government. I'm sure that's going to throw up opportunities, and we do have on the commercial side of Paragon a very strong and successful development finance business, and that may bring opportunities to look at. So what I'm not going to do today is commit until we can say, yes, we're ready to do something, but certainly I think we're open to opportunities in terms of how we can support landlords and the wider PRS.
Brilliant. I was never going to ask you to commit today, Richard, don't worry.
You'll be one of the first to know, Steve.
Yeah. Thank you. Well, gents, sadly we're out of time.
I think you just want to be exclusive.
We'll negotiate off air. Brilliant. No, thanks for your time today, gents, but sadly we're out of time. I'd like to wish you both all the best of luck in sort of navigating both your businesses through to the end of this year and into whatever 2021 looks like. But thanks for your time today, gents, and see you again very soon.
Steve, Hans, Richard, thank you so much. That was really interesting, and I particularly loved hearing about your thoughts for how the property market may look post the stamp duty holiday ending in spring of next year. So next up, I'm delighted to be joined by Julian Sampson and Chris Frame. Now, this session is going to be really talking more about the technical aspects of limited company lending. So why you would use a limited company, what the benefits are, how you even set one up, and the different kind of structures that you can use when setting up a limited company as well. So it should be really informative. By way of an introduction to our guests, Julian Sampson is partner and head of TWM's lending team, He represents national and global lenders and acts for borrowers in portfolio restructures or complex acquisitions and refinances. Chris Frame is VP Growth and Business Development at GetGround and has worked in the property and real estate industry for over 17 years. He previously worked at Barclay Group and is a trusted resource for knowledge and guidance in the UK and international real estate networks. So we're delighted to have these guys with us today to talk more about limited companies. Julian, Chris, thank you very much for joining us here today. We really appreciate you taking the time to join us at MFB Live. I'd like to start off by asking you, Julian, what is an SPV and how is it different to a trading company?
So an SPV is a special purpose vehicle. So as the name suggests, it is set up for a particular reason. And it was historically, SPVs were historically part of structured finance. So you'd see them sort of lots of bankers talk about SPVs, all set up for weird and wonderful banking operations. And it's only sort of latterly that they have become more mainstream and people have sort of come around to the vernacular of what an SPV and what it does. The reason you might lead into an SPV is because you want to essentially silo what the asset that you are acquiring or own. And they have a number of great points to them that provide some clarity for both you as the owner of the SPV and any third party looking in. So they can be established to be separate for accountancy purposes, for tax purposes, for insolvency purposes, as opposed to a trading company, which tends to be very fluid. So a trading company, as the name again suggests, might well be something that you, if you own a premises and you trade out of, so if I own a shop, I might hold the lease in that shop and receive the income out of that shop as part of a trading company. And as the name suggests, you get income flowing into all sorts of different things. It might be till receipts, it might be income from a number of other areas. And it's that mishmash of income and deductions and liabilities that makes it very difficult to essentially pinpoint which bits relate to which assets, which relate to which liabilities. And that tends to muddy the waters and it becomes very difficult for lending underwriters, solicitors included, to be able to try and pierce through all the noise in a trading company and understand really what they are wanting to focus on, which essentially what we're talking about is the ownership of the asset, the renting of that asset, the mortgageability of that asset, and from an underwriting perspective, the control, the good management, which is where Chris and GetGround will come in, and the financial stability of that asset. And within an SPV, it is contained. So that's why it's become more popular. But those are essentially the difference between an SPV and a trading company.
I just want to say that is the best explanation I've ever heard as to why lenders may prefer an SPV over a trading company. So thank you for that. Chris, could you please give us a quick overview of the process of setting up an SPV limited company?
Yeah, of course. So GetGround as a business, we've essentially created a new solution to setting up a limited company. We specialise very much in setting up limited company structures and then actually running those limited companies, and touching on what Julian just said, for the sole purpose of buying investment property in the UK. So these are SPVs designed specifically to buy and then hold UK property. The process that we've created removes two of the biggest prohibitive factors that have previously existed within the marketplace, one of cost and then one of time. So it used to be a very expensive setup process and a very expensive process to run those limited companies, and equally a very time-consuming process, again, during the setup and then indeed the ongoing financial administration of that company structure. The GetGround solution, however, can all be done online. It can all be done remotely. It can all be done in as little as 20 to 30 minutes. It is a very simple three-stage process of registration, then of a bit of KYC, so know your client, or the uploading of AML documentation, so a proof of ID and a proof of address. And of course, given that the modern day technology, a selfie picture, and then the final stage is then filling in the property details for which you are acquiring. And then thereafter, each shareholder would essentially repeat that process, just the uploading of the ID and uploading of the proof of address at their own AML documentation, at which point we would produce and verify all of the legal documents that again can all be signed electronically and again all online. So the initial input would take 20 to 30 minutes. If I erred slightly on the side of caution, we would then have that limited company structured, finalized, web filed within 24 hours. Typically, it's a quicker process than that. And then thereafter, we also open a UK bank account for that particular limited company, and that would be open 72 hours once the company had been created.
That's fantastic, actually. I know when I set up my limited company, the two things that took the longest period of time was setting up the bank account. I couldn't believe how long that actually took me. And the other thing, which was really time consuming, was the what should I call my company, which was the most fun bit, I think, of the process. But I guess that you guys really are finding a solution that will really save time on things. I mean, in your experience, where is the biggest time saver? What normally is the most time consuming part of setting up a company?
I guess now that it's, as I say, it can all be done very, very quickly. So there almost isn't a particular time-consuming part. I actually agree with you. My own experience prior to GetGround was exactly in the naming of the company. But we've actually removed that from the marketplace as well. We have a standardised and a formula that's been agreed both with Companies House and indeed with the UK government as well. So all of our companies follow the same format, which is GG-3 numbers limited. So for example, GG-123-456 limited. And that, as I say, is a proven process that all solicitors or mortgage lenders are agreed to, and indeed, of course, Companies House. So that's removed that side of things. A lot of it actually just comes down to individuals now finding the time to complete the process, which is a beneficial side of things. But yeah, as long as an individual can give up sort of 20, 30 minutes or so, the whole process is very, very quick indeed.
Fabulous, thank you. And I suppose while we're just talking about SPVs here, I mean, Julian, why do they actually use SPVs?
So I was thinking carefully about this morning. I mean, there is an argument, of course, that people just use SPVs because that's what you do. But let's give everyone a bit more benefit of the doubt. So my view is there's three shuns. I had to really shoehorn this into my presentation this morning. But the first is incorporation, the second is contamination, and the third is presentation. So from an incorporation perspective, Chris has obviously gone through the process. But there are some real benefits of an SPV and incorporating, because you can identify that business does what it says on the tin. In other words, it's a property rental business. And that's really important from incorporation perspective when we are incorporating, for example, portfolios from private ownership, because making sure that you can identify something as a property lettings business means that you open up all manner of potential capital gains tax reliefs when you're incorporating that portfolio. Because under the not so recent case now, Ramsey, the lady involved in the case had to establish that she was doing more than just owning investment properties, was actually engaged in the letting and management. And of course, back to my first point, if you can show and identify the income receipts for rental, the outgoing liabilities, and your involvement in it, there's a better argument for the revenue in relation to the management of that and establishment of that incorporation relief. So incorporation one and group structuring. So again, if you have an SPV, you then have the ability to have holding companies, subsidiaries, sister companies, and again, all manner of different reliefs open up from your tax structuring perspective. And again, having a system like GetGround that enables you to run multiple SPVs alongside each other gives you that complexity, but also with a bit of management support. So incorporation. Contamination is another. So we talked about very early on about the insolvency protection you might get if you had an SPV rather than a trading company. So having each SPV is a separate legal entity, so that if I have something going wrong with one of my assets, or I have a void, or if I have a licensing problem on an HMO, and that is all contained within a single SPV, and that SPV is going under very quickly, then I'm not cross-contaminating into any of my other entities. Whereas if I held everything in one single trading company, for example, if I have one bad apple asset, then that is going to contaminate everything else. And so what might otherwise be really strong assets or really strong performance might be impacted by something that's actually just unfortunate. So contamination is a really important point. And then presentation. So this is back to you, Jenny. So this is about how do you present something well to an underwriter at a lender, and having something that is clear and clinical and easy to identify means that the underwriter is not going to have to scroll through whether or not you've got cash flow insolvency or balance sheet insolvency, trying to understand the implications of running a tea shop through your trading company when you've got 3 assets next door. It becomes very, very complicated. Not to say that with your skill and the underwriter skill, they couldn't get through it. But as far as the owner is concerned, that's just more information, more paperwork that they've got to identify and disclose, which they just may be uncomfortable doing. So those 3 reasons are one of the sort of 3 areas that I would suggest that people use SPVs.
Yeah, I think that's great. And I think it's fair to say that when we think about the number of lenders who are offering limited company mortgages to SPVs versus those lending to trading companies, while there is a market for the trading company borrower, it is significantly smaller than the SPV option. So, yeah, we can absolutely see how that pans out in terms of appeal to lenders. And I suppose another question for you, Julian, is, with using an SPV, are there legal advantages for the actual borrowers? So, for example, someone wanting to invest with a business partner, for example.
Yeah, so, you could look at the legal advantages in 2 manners. So we've touched on the tax advantages of incorporation and SPVs, but there are also ongoing tax advantages. If I have an established rental business through my SPV, then there is this horrific tax that sits in the background called enveloped dwellings tax, which is both an annual tax and a 15% surcharge, which if I'm running and I can identify a property lettings business through my vehicles, then that sort of disappears out the way. So these are all things that sort of you can, again, it's about being clinical and clear and concise in running your SPV. But practical benefits, there are succession points. If I want to ensure that my family benefits from the asset that's sat within the SPV, then I can start to issue shares in their favour. And as long as we go through conversations about what that looks like as far as the lender's concerned, then that is a good way of ensuring that you can allocate income by way of dividends or simply grow capital within a company that eventually on death, rather than having to wait for probate, those people already have shares. My children already have shares in that company and then can pursue and enjoy that on my death. So part of succession planning, If I'm going to retire, then there are benefits in distributing the income and the conversion of capital to income in an SPV, because when I retire and sort of collapse my portfolio, for example, I can then have that distributed as income. And of course, as a retiree, my income tax liability will be much less than it is now as a working person. So that gives you that sort of flexibility. There are benefits in relation to SDLT on owning your own home. So if I own shares in an SPV, that means that I am not going to be liable to the higher rate of income tax when I buy my own home, because I don't have that additional property in my own name. I have shares in the SPV. And then there's personal liability benefits. So, if something does go wrong, then we talked about the idea of cross-contamination. There is the personal liability that comes from, or the lack of personal liability, but under guarantee, that comes from owning a limited company, means that if there is going to be, say, litigation with, let's say, the council on operating an HMO, that litigation is principally, unless I've done something really badly as a manager, but that litigation is going to be against the vehicle, not me personally. So I'm, again, siloing myself from personal liability beyond any personal guarantee I might give to the mortgage lender. So there are those sorts of benefits. As far as a business partner, Jenny, I mean, bringing someone on as a shareholder, this might not just be for succession, it just might be as a genuine partnership. That also brings up opportunities for incorporating portfolios and benefiting from certain reliefs that are available to partnerships in doing so. So again, you can then start looking at mortgage interest relief benefits and onwards and onwards. So it opens up, and as I've correctly identified, the opportunities for lending with SPVs are as good now, certainly in relation to rates, as they are, for example, in personal names. So there are certain lenders that will have an absolute flat blanket between the two. So if you have an understanding of why you want to go into this, and you get help in the administration with the likes of GetGround and yourself in relation to underwriting and positioning something with a lender, it just opens up a whole new way of building a portfolio with some certainty and stability.
And I'm just listening to you, and it's absolutely fascinating. But what I'm really kind of in my mind thinking is, it's so important that when people do this, they get some really good advice in terms of how they structure things, and the tax side of things. It's more involved, isn't it, than maybe one would be forgiven for thinking. And I think that really links nicely onto the next question, actually, I wanted to ask you, Chris, because this is something we get asked all the time, which is when the company actually sells the property, how are they taxed on that?
Yeah, it's a very common question, actually. It's one we get asked a lot about. And actually, it's where a lot of the financial benefits can exist, as well as during the ownership period. There's then also benefits that come from a more efficient model on exit. So if you own a property in your own name, you will be liable for capital gains tax. That's regardless of where you're based, where you reside, what your nationality is. Capital gains tax in your own name is either 18% or 28%, subject to the tax bracket that you fall into. If you own a property in a limited company structure, you've actually got two mechanisms that are available on sale. And in that scenario, you can either sell the shares of the limited company, or you can sell the property out of the limited company structure itself. And if you sell the shares of the limited company, then you would pay a reduced capital gains tax. So that would drop to either 10 or 20%. So in either tax bracket, an 8% tax saving, which, given, as we know, typical performances within the property market, particularly whereby investors tend to hold for sort of 8-10 years on average, which is a common time frame of property prices doubling in the UK, that capital gains tax can be quite a significant amount of money. So that sort of saving can equally be a pretty significant amount of money as well. If you sell the property out of the limited company structure, so this is more common if I was the incoming buyer and I was planning on living in the property. So my own view, and this is sort of what Julian's touched upon as well, is that limited company structures make a lot of sense if you're buying a property for investment, i.e. looking to generate an income from it. And if I was going to buy the property from the seller for the same reason, for investment purposes, then I would likely buy the shares of the limited company, because I would get the benefits that a limited company offers, that particular investment purchase. If I was the incoming buyer and was going to buy for my own use and actually live in it myself, then I'd probably get more benefit of actually buying that property out of the company. So it means you've got both markets available. So there's an element of you've got greater flexibility to when it comes to selling. But in that scenario, the seller actually wouldn't pay any capital gains tax, and instead they would pay a flat rate of corporation tax, which right now is 19%. And then from there on, it would then differ slightly just on how you withdrew that money, subject to where that individual was then based residency status-wise. So, for example, non-UK residents actually would take the remainder of that balance as a dividend without incurring any income tax on that balance as well. So, but again, all part of our services is in around the financial administration of these limited companies. So we would always look to try and help wherever we can to make sure that the most efficient route was being taken by our customers.
Perfect, thank you. I think it's interesting actually that you refer to the selling the shares of the company rather than necessarily selling the property it's out of the company. We're definitely starting to see an increase in investors looking to buy in that way. And I think the mortgage market hasn't actually quite caught up with that as a requirement, because it becomes, instead of a house purchase, it's a share purchase deal. And I know that some of our lenders, or most of our lenders at the moment, are still quite unsure how to navigate such a thing. And Julian will be familiar with the legalities of a share purchase transaction. So I do think it's definitely a part of the market which is set to grow exponentially, actually. And let's just hope our lending partners can come up with a solution to fit around that.
I think, sorry, Jenny, to butt in, but there's an interesting point you know Chris led to, and you've followed up on, which is, you know, and this goes direct to the heart of what we're talking about between an SPV and a trading company. If I am doing a share purchase agreement in a trading company, the due diligence that you go through as a lawyer is extensive, and you know you have to issue disclosures against certain things that happen. And the legal fees for what might be from a financial sector, a relatively small transaction could easily run into tens of thousands of pounds. I mean, very, very easily. Whereas if we are looking at an SPV, we've got a single asset, we've probably got a single liability. Yes, there might be moving parts in relation to the rental, but the due diligence is vastly pared back. And then, you know, bring in a service like what Chris is using, they're administering. So again, we've got a single point of truth in relation to what exactly is happening with that SPV. And so, you know, not wanting to do myself out of extensive fees, but with an SPV, we've got great opportunity to actually, as you say, open up the market, so mitigate the tax liabilities in relation to passing on an asset and selling an asset, because we've got different options in relation to the shares. So it's a really good point that's been raised there.
Yeah, and actually that's really interesting, because you just mentioned about having a single asset in an SPV. And one of the questions we get asked often, and maybe Chris, you could help me with this one, is, you know, so people say, can I have more than one SPV company? And then should I put every single property into a separate SPV? Or, you know, how does it all kind of tie in together? So I suppose, yeah, you know, I mean, can you have more than one SPV? And, you know, are there advantages to having more than one? How do you see that looking?
Yeah, so the simple answer is yes, you can. You can have one company and then hold multiple properties in it. The GetGround model, we actually don't offer that. We very deliberately do a one limited company per property model. There are a number of financial benefits that come from that. And because our fees are significantly lower than the previous and the traditional costs that were involved, it's therefore far more justifiable to set up on a one limited company per property basis and then get the financial benefits from that. It does help bring a greater level of trust and transparency, which Julian's obviously touched upon, particularly from a legality perspective. We create brand new UK limited companies. We produce and verify all of the legal documentation for those documents as well. They've all been created by a company called CMS Law, who are quite a prestigious law firm. So each company has a very high quality legal documents, and therefore that makes the ongoing due diligence very easy. The other thing I would mention, we set up that model because of the financial benefits, and we touched upon it a little bit when talking about selling the shares and or selling the property out of the limited company. If you own multiple properties within one company, you actually lose the flexibility to managing that portfolio. If you wanted to sell one, transfer one to a child, keep one, you actually can't do that via the transfer or selling of the shares if you own multiple properties within one company. Mm-hmm. Only way you can get full access to the reduced capital gain tax benefits is if you sold the entirety of that portfolio. So we would set it up on a one company per property basis for financial gains and the financial advantages that come from that. It does provide other benefits such as greater protection. Julian's already touched upon this as well, but essentially each limited company and therefore each property it has its own legal ring fence around it. So essentially is independent of the other. It helps investors establish the exact cash flow and the performance of each individual investment. And in some cases, we've seen some mortgage lenders prefer a one limited company per property model for the simple reason that you've got one company, one property, one mortgage. And so it's very, very transparent as to which asset is being used as security for each mortgage itself. So we do it specifically for the financial benefits that we think it offers our customers and helps enhance the use of a limited company structure. But there are multiple other benefits within the marketplace that come from separating out and using multiple SPVs.
Yeah. There's one significant one, I think, as well, which sort of flows on from that, Jenny, which is, and we've touched on this in other webinars, but where you are an investor and you need to carve an asset out of a single unit. So let's say in a freehold premises and I need to grant 2 leases out for 2 flats to get them to mortgage, or I've built a plot on the sort of back end of my house and I need to separate that plot in order to get a mortgage of it. And because you can't contract with yourself, and either as an individual or let's say you held everything within a single limited company, you need to establish ideally another limited company, another SPV to hold those assets which you're carving out. And in doing so, you can then, certainly if it's set up and established in the right way, you can then achieve all manner of SDLT reliefs by either group or restructuring relief that enables you to mitigate any SDLT liability, even though the lender is requiring you to transfer those assets out at value. Yeah. So there is some real significant benefits in relation to that, the structuring of the physical assets as well as the financial side of it, which really shouldn't be missed.
Yeah, that's fantastic. Thank you. It's so interesting, actually, because I think the natural response from our clients tends to be, I just want one limited company because it's one set of accounts and one lot of accountancy fees and, all the various bits and pieces that go with that. So it's really interesting to hear that actually there's some really profound knock-on impact or effects from not actually separating things out. So thank you. That's really useful. I think that's us done, guys. So thank you so much for joining us today. Really appreciate your time. And we look forward to seeing you again very soon.
Great. Thanks, Jenny.
Thanks, guys. So following on from that, I'm now going to talk to our own Director of Sales, Gavin Richardson. Now, Gavin has over 12 years' experience in the financial services industry. He's worked for HSBC, Lloyds, TSB, NatWest, and has also been a professional rugby coach for England's RFU, the Harlequins RFU, and Sussex University. Now, he's responsible for all of our regulated commercial and buy-to-let mortgage activity within Mortgages for Business and has therefore an expert understanding of the limited company mortgage market. So we're delighted that Gavin is able to join us today to talk a bit more about buy-to-let limited company mortgages. Gavin, thank you so much for joining me today. I know you're incredibly busy with all those mortgage applications that are coming on with all the people making the most of the stamp duty holiday. So thanks for taking the time.
No problem.
We're going to be talking a bit about limited company lending. It's incredibly topical at the moment. And at Mortgages for Business is something that I know that we do in abundance. So I feel that you can really talk with authority on this subject. So the first question I have for you today is, how have lenders' attitudes towards limited company lending changed over the last 5 years?
It's an interesting question because so much has changed over the last 5 years, realistically. I think lenders have had to become more proactive, more positive and more professional in the industry, forced potentially by the PRA changes that came into effect back in 2016. So having to do some mandatory requirements, mandatory stress testing, being a little bit more thorough on their applications, looking a little bit more into the history of the lender and existing properties and then complying with legislative changes that came into effect during that 5-year period as well. So, EPC certificates, HMO licensing, tenant evictions, all those types of things have forced lenders to become more professional. If lenders have got to become more professional and applicants are professional, then the two dovetail quite nicely. So I think lenders have actually been very supportive of the professionalisation of the industry. And it's become more competitive at the same time. As more lenders get to understand the industry, more have come into the market. 5 years ago, there wasn't too many lenders actually specialising in the limited company application. Probably count the lenders on 1-2 hands, maybe at a push. And now we're inundated with lenders looking in that market, which has forced the industry not only to become more professional, but more competitive as well, which is only a good thing for our customers.
Absolutely. I remember when I joined Mortgages for Business 15 long years ago, and then there were only really 2 or 3 lenders, and when a client would say they wanted a limited company mortgage, we were quite surprised. It was quite rare to come across it, whereas now the world's really changed, hasn't it? And the market has stepped up to reflect clients' requirements, which is fantastic.
Absolutely.
On that note, what would you say are the main differences between limited company mortgages and those mortgages that are available for individuals?
Again, this is interesting. It kind of almost dispels a few myths out there on the complexity of doing a limited company application. Not to say that brokers aren't highly skilled, but aside from the obvious tax regimes that are in place from the sort of applicants' benefits of doing it in a limited company, it's the directors or the shareholders or both that are underwritten as the individuals. The company that's set up can be set up yesterday, so it doesn't need a trading history. So there's nothing particularly clouded in mystery about that side of the application. Yes, rates potentially can be slightly higher for a limited company application than a personal one, but that again is also dependent on the applicant, the type of property, loan to values, and all those types of mitigating factors. And I suppose the one thing that is evident is the limited company applications do usually require a little bit of additional supporting documentation. Obviously, you've got a company, we need to know about it. You may have more than one director, you may have made more than one shareholder, and that naturally increases the amount of underwriting that is required. So it may take slightly longer. But fundamentally, there's not much difference between the two.
No, I absolutely second that from my experience. And I suppose it's worth asking, do limited company mortgages offer any particular benefit for portfolio landlords, those landlords with 4 or more mortgage buy-to-let properties?
Yes, fundamentally. There are a number. I mean, there's the obvious one because the PRA, which we mentioned earlier, they changed their stress tests in 2016. So it's likely that as a limited company applicant, you should be able to borrow more. It's a more favourable stress test, therefore your borrowing, you should, based on the rent, be able to achieve slightly higher borrowing than a personal loan. We mentioned that the favourable tax structure of owning in a limited company. I'm not going to get into the implications of tax and they're giving you any advice on those lines. That's for your accountant. But fundamentally, you should be able to borrow more. The lender will assess your existing portfolio and ascertain your professionalism and make sure that your business plans and your assets and liability statements support a new application. And that puts you on the right track. It almost stops you going gung-ho down the wrong route if a lender is assessing, your suitability for your next, mortgage or property acquisition. So it does support the professionalism of becoming, a full-time landlord or a professional landlord in a limited company when you have the lender sort of sense checking everything you do. I know it sounds a little bit big brotherish, but it does support the application and make sure you are doing the right thing for the right reasons.
And I think as well, what we find is that the types of lenders who lend to limited companies are those lenders who are more the specialist lenders who are very landlord friendly. So a larger portfolio, it doesn't scare them, does it? Whereas some of the high street institutions, the kind of clearing banks, they're not big fans of those landlords who are particularly exposed to the property market. The guys who operate in the specialist end, they welcome landlords with open arms, don't they? So it's a really good marriage between the two, I think.
Absolutely. As we see more and more lenders come into the market, the increase in the specialist lenders paid off in spades in terms of understanding what the applicant is trying to achieve. And there's also a certain degree of tailoring of products over the last 5 years to actually support what landlords are now trying to do, whether it's a blended portfolio of commercial and residential or specialising in student lets. Products are being designed to support what is the growing trend in the property market. So, yeah, it's been advantageous all round to actually see them grow.
Perfect. Now, I think it's fair to say that the lenders are a little bit busy at the moment.
Not just the lenders.
Sales for processing applications has on occasion slipped for some lenders, and it is definitely some more than others. It's not all. But at the moment, what would you say the current processing times are for limited company mortgages?
I think it's probably worth caveating it's fairly unique at the moment, and a number of our lenders and lending colleagues have gone through fairly tricky times, and not all of them are back up to full staffing levels at the moment. Some have had to cut their cloth and unfortunately make some redundancies, and some have had to apply a lot of their resources to looking after existing customers that needed payment holidays. So it is a difficult time. So not making excuses for them, but there is kind of rationale behind why service standards have slipped at the moment. But the answer to the question is quite broad because it varies. It varies between kind of 2 days up to 17 days at the moment. And that's at every stage of the application. So it may take one lender 2 days to assess a document. It might take a lender 5 to 8 days. Yeah. It might take one 5 days to produce an offer. It might take one 10 days to actually get the document and then produce the offer. So the answer is as simple on the research that we've got, between 2 and 17 days, to kind of give customers reassurance and kind of things are being worked and being pushed through. This thing is changing regularly. Staffing levels are returning to normal. Lenders are starting to open their door and be a little bit less risk averse, and therefore assessing things a little bit quicker and a bit more, or using the sort of previous automated processes that were in place rather than manually underwriting. So it's improving daily. Yeah. However, the other kind of word of warning, I suppose, within this whole thing is, everyone is busy at the moment because everyone is taking advantage of the stamp duty holiday. So application numbers are increasing. So with a shortened sort of headcount in most lenders' service departments and an increase in applications, this will continue to march. So if you're going to beat the stamp duty or take advantage of the stamp duty holiday, I would probably add 2 weeks to any normal kind of standard. On if you expected an offer in 4 weeks, make it 5. You expect a completion in 8 weeks, make it 10. Be safe, don't miss the deadline.
Yeah, don't leave it to the last minute is the message there, isn't it?
Yeah, it's critical that you know that at the beginning. If you're looking at a purchase, that you manage all parties. We know that estate agents will be pushing for offers and vendors will be nervous, but things are taking longer than normal. So if you've got a remortgage coming up and you don't want to go onto the standard variable, start early.
Sure. Okay, thank you. And Gavin, the last question I wanted to ask you is just about pricing. So I think there is a perception that limited company rates are expensive. And I think there's been, it would be wrong of us to pretend that over the last few months, the gap between limited company rates and vanilla rates have kind of parted. Now they're starting to come back together again.
Yeah.
But at the moment, where do limited company mortgage rates start from?
Yeah, so if we look at the kind of standard, if there is such a thing anymore, given the last sort of 6 months in the market, most of our customers look for a 75% loan to value product, and that's kind of where it works. That's the kind of minimum deposit needed nowadays. So if you're looking at a 2-year deal, and I would just kind of caveat this, that the cheapest rate's not always the best rate for you as a client. It might not always be if you add on fees and service survey charges and arrangement fees. The cheapest rate, headline rate, isn't always the best. So check it with your broker because there might be better deals that suit you better or are more appropriate to the property. You can probably get a 2-year deal at the moment around 2.94 on a 75% loan to value and a 5-year rate around 3.19. Compare that to the sort of personal applications, and you can probably shave on a 75% deal about 1% off that at the moment. But that's a high street deal, high street lender, bog standard property, high rent, low yield, probably making sweeping generalisations. But people need to understand that you might.
Are you?
Yeah, people need to understand that higher rate is probably compensated for in tax savings, but that's again for the accountant and the individual to work out.
Yes, let's not go down that path.
Not draw me in on that one.
That's all my questions for today. So thank you so much for taking time to come and chat with me.
My pleasure.
And we'll catch you again in the next few weeks. I'm sure one about other landlord events.
Lovely. See you soon, Jenny. Thank you.
Bye. And now it's time to move on to the last segment of MFB Live to answer some of the questions that you have emailed in the run-up to this event. Now, I'm afraid we're not going to get time to answer every single question. There were quite a few. So we've picked out a few that we feel will be particularly of interest. But for those people who have emailed in, and we don't get to answer your questions today, what we will be doing is writing up all of the questions and answering them and sending them around to everyone who participated in MFB Live. So you will be getting your question answered, but not necessarily on this video, but maybe in a follow-up email in due course. So the first question we've been asked is from Demetrius, and he's asking us our thoughts on limited company interest rates and the direction of those. He's also asked us the criteria for lending on a newly set up limited company. So in terms of, first of all, our thoughts on pricing for limited company interest rates, what we saw at the start of lockdown was an increase in limited company pricing. And there's quite a lot of very good reasons for this, which were largely linked to the fact that lenders had to move bodies around their business to cope with the payment holiday requests. We had no surveyors going out, and there was lots of changes to process that lenders had to do and implement to ensure that they continue running their businesses well. So first thing they would have done is push interest rates up to stave off business to ensure that they could cope with the new applications coming in. The second thing that happened was the capital markets closed for a period of time, which meant that there was less money around for these lenders to access to then lend back out to you guys, which meant that the cost of funds became more expensive. Now, the lenders are back, the valuers are back out, the capital markets have reopened, and things are in a much better place now. And on the back of that, what we have seen is the specialist pricing start to ease back down. So in terms of where I think it's going to go in the future, I think there is room for it to come down potentially a little further, but I don't think it's going to come down massively from here, largely because when we look at the cost of funds versus the margins these lenders are charging, they still have to make a profit. So I think we're nearly at the very sort of bottom or flattening of the reduction curve. In terms of borrowing through a newly set up limited company, so it's worth just knowing that when you set up a limited company, you can borrow through it the very next day. And the reason for this is when lenders lend to limited companies, what they will do is take an unsupported personal guarantee from, and depending on the lender, either the shareholders and directors or just the directors of the business. And so these personal guarantees form really the basis for which the lenders make their decision to agree to lend to a company. So when you apply for a limited company mortgage, you will find that you're very much answering questions about you as the individual, despite the fact the lender's lending to the company, because you're who the lender is ultimately hanging their hat on. And so the entry requirements for limited company borrowing are actually very, very similar to those if you want to borrow money through your personal name, in terms of some lenders need you to earn £25,000 a year, some don't mind, there'll be a rental calculation. This is actually more generous if you use a limited company than if you go in personal names because of the tax benefits of using a limited company. Lenders tend to prefer that you're a homeowner, but actually if you're not, that's fine too. There are lenders who can accommodate that, no problem. So yes, actually the criteria for limited company lending is very, very similar to normal buy-to-let. So I hope that answered your question. Now, Julie has asked us, if an investing partner moves abroad and the other partner remains in the UK, what are the implications or consequences on existing mortgages and on future potential to obtain mortgages? For all categories, actually, so principal primary residence, buy-to-let, holiday-lets, commercial property, short-term and development projects. So first of all, if you have two people that have a mortgage and one of you moves overseas, whilst you should notify the lender of your new address, it really shouldn't have any impact on the existing arrangements that you have in place. It's very unusual. I've not heard of a lender saying, oh, you're going overseas, so we want our money back, or anything like that. So it really shouldn't have any impact on existing arrangements. In terms of future borrowing, so where we have one person who's onshore and one person who is offshore, lenders will then treat the application as, generally speaking, an expat mortgage. Now, in terms of the expat mortgage market, there are lenders who are happy to take on mortgages from expat applicants. You will find it's a much reduced appetite. So there's a lot less lenders offering these, and the pricing can be higher. So it will have an impact on this for you because it's quite a limited market. Now, the only time that I think you can probably avoid this becoming an issue for you is if you have a limited company where you have the remaining person who stays onshore is the company director, but one of the shareholders moves overseas. And then it comes back to this point, which we just talked about, which is who lenders are taking the personal guarantees from. So if we have a shareholder who is non-UK resident but a director, and potentially a majority shareholder who's UK resident, you may find that some lenders won't want to underwrite the person who's overseas, and therefore that would not be treated as an expat application. I hope that helps. David has asked us, what's the panel's view for long-term property investment considering the fallout from COVID-19, commercial or residential? And that's a really good question, and one we're getting asked quite a lot at the moment, David. So in terms of my personal view for property investment, I'm fairly confident in the residential space. Still in the UK, there is a shortage of property overall. There is a restriction on the number of first-time buyers who can access their first homes. The numbers are quite tight and actually reducing at the moment, particularly right now because of lenders scaling back on their high loan-to-value products, which means the demand for rental properties is actually very solid. So I think in terms of going forwards for residential property, I think the prospects are actually very good. In terms of commercial properties, now this is quite a different conversation, isn't it? What we have seen with COVID is a real change in people's behaviours. So offices are less occupied or even unoccupied. Retailers are, we're all doing a lot more online shopping than we used to, and cafes, bars, and the leisure sector has obviously seen a real downturn as well. Now, I think it's going to be really hard to call on the very long-term impacts of this, but I do think there will be a natural adjustment in terms of how people use commercial spaces going forwards. So I think personally, I would be slightly more cautious about investing in commercial at the moment. Now, that's not to say that all commercial investments are doomed to fail. That certainly is not the case. Obviously, there are particular services that are continuing to trade, very, very well. Supermarkets, for example, are still doing loads of business, so they're holding firm, so it's not all sectors. But I think if you are thinking about making a commercial investment at the moment, you need to have a really long think about the kind of tenant that the property would attract and the longevity of their business, particularly in the kind of next 6 to 12, even 18 months as we go through this period of time together. Melanie has asked us, I have a few properties in my name and I'm wondering if it is worth transferring into a limited company and how easy is it to obtain a limited company mortgage? So hopefully I've largely covered off the second point of your question in terms of ease of obtaining a limited company mortgage. I know that when I have spoken to some clients in the past, they've always felt that the limited company mortgage felt complicated because it's a limited company, and actually once they've gone through the process they were pleasantly surprised at actually how straightforward it really is. In terms of transferring the properties into a limited company and whether it would be worth actually doing, I mean, that's really a conversation that is something you need to speak to a tax advisor about, because your real motivation for moving the properties into a company are going to be tax-led rather than mortgage-led. So what we tend to do for our clients in these situations is we will put together a proposal which would say, if you were to remortgage properties in your name, this is the kind of interest rate you can attract. If you were to move them into a limited company from a mortgage perspective, these are the costs associated, so valuation arrangement fees, and here is the interest rate that you would pay. And then what our clients will do is take this information to a tax advisor or an accountant and get them to kind of do the maths in terms of the various tax implications that sit alongside both of those scenarios and try and ascertain which way is going to be better for you from a financial perspective. So I hope that answers your question, Melanie. Edward has emailed in simply asking about age. So it's a really good question, actually. And as we know, we're all living longer, thankfully. And we are seeing more and more clients who are in their 70s and even early 80s who are looking for mortgages. So in terms of attaining a buy-to-let mortgage when you are in your later years, It's actually a part of the market which has moved on somewhat in terms of lenders' criteria. There are lenders who, well, let's go back a bit. So actually, if you just said to me simply, what is the maximum age? Traditionally, most lenders would have want their mortgages repaid by your 75th birthday, but the world's moved on a bit since then. So there are some lenders who still have that kind of criteria. However, there are also lenders who actually don't mind about ages. So you can essentially apply for a mortgage at 75 years old and get a 25-year term. So I think what it's fair to say is that the older that you get, the narrower the choice of lender that you have becomes. So obviously, we'd be delighted to have a chat with you and talk through your options. But actually, age is not a prohibitive factor by any stretch of the imagination when it comes to taking buy-to-let mortgages these days. Now, Samit is asking us, I currently do not own any properties personally or in a company, and I'm looking at purchasing an investment property through a company, and I'm also looking at purchasing a personal main dwelling. Which order should I buy these to have an impact on the amount of stamp duty that you have to pay? So I guess the good news here, Samit, is that actually it won't make a huge amount of difference. So if you own a buy-to-let property in a limited company and you do not own a property personally and you make your first purchase of your own home, you will not pay the 3% surcharge on the property that you're going to live in. Likewise, if you buy that property first, you wouldn't pay the 3% surcharge on the property you're going to live in. What you will always pay is the 3% surcharge on the property that's in the limited company. By virtue of the fact that you're buying a property through a limited company, you just pay the 3% surcharge because it's not going to be your own home. So actually, I'm hoping this is good news for you. It won't make any difference which order you buy these two. The key is, though, to separate the two. So ensuring by putting the property in the limited company, it keeps your first-time buyer status when it comes to purchasing your first main residence and therefore the stamp duty benefits that come alongside of that. Now, the last question I'm going to cover off today is from Deepak, and Deepak is asking us, what is the most cost-effective method or product to finance the deposit for buy-to-let properties from unencumbered properties? So the really good news, Deepak, is actually the mortgage interest rates are very, very good. I mean, I remember a time, and I've been in this industry for more years than I probably want to share with you. And actually, I remember sort of saying to people, gosh, this is a 5-year fixed rate and it's under 5%. This is fantastic, These days, we can secure 5-year fixed rates at, 2%, 2.5%. Limited company pricing can be just over 3%. But remortgaging on a first charge basis, non-encumbered property, to raise funds for a buy-to-let is always going to be the cheapest way to raise deposits for you. So yeah, I hope that helps. So look, that's everything from us today. Like I say, for those people whose questions we haven't got around to, I am really sorry we didn't get the chance to answer those for you this afternoon. But we will be writing out to you with all of that information and following up on those. So just bear with us. And that's it. So thank you to you all for joining us today. I do hope you found it useful. I know that I've actually really enjoyed the conversations we've had with our guests. I've actually learned a few things myself. So it's been really interesting. And if on the back of this you do have any questions, please do feel free to email in. And as always, our website is a really good resource for lots of information. We have stamp duty calculators, mortgage calculators, blogs, case studies, just lots of information there. So do go and have a look. It's mortgagesforbusiness.co.uk. And lastly, if you did want to have a chat with one of our brokers, we're very, very happy to have conversations with you. Very, very friendly bunch. Our phone number is 0345 345 6788. So once again, thank you so much, and hopefully we'll be speaking to you very soon.